Welcome to the program. Today we'll look at what's happening on the markets. We'll discuss the commodity bear market and we'll ask the question, are the banks a buy? I'm Peter Switzer.
I'm Peter Switzer and we're mad about money.
Morning, Pete.
Hi, mate.
So markets pretty flat overnight. Some commentary from Yellen that rates will continue to rise. I feel like we're saying this every week. Big question I've got at the moment that I'd like to ask you is, why is North Korea being dismissed? Do they not see it as an issue? Trump putting out a lot of negative rhetoric, referring to party leader as Little Rocket Man. What sort
great
of
song, wasn't it? Rocket
it was a great song. Pretty aggressive terminology. What sort of impact should this be having, and why isn't it having an impact so far, or is it?
Yeah, despite all the stuff we're seeing in the media, and I think most sensible people say, why in the hell is he saying that? And I think some European politicians are saying exactly the same thing. He's going too far. I think he's gambling. At this stage, I think Wall Street is actually believing that Trump will get away with it. They're probably believing that Kim Jong-un, Rocket Man, and nincompoop though he seems, he's smart enough to realise he can't go into a war. So that's the bet. They could be wrong, but that's the bet, and that's why the market's not really worried about. And I think also there's still a great belief that Trump will come up with something. And the latest one is that some people think that the tax reform package will be outlined in the last quarter of this year. Some think it might be passed before the end, but most are thinking maybe out in the first quarter. But if it's really well named, there's lots of support, the stock market will like it. It will rally into the end of the year if they can pull off those.
And there's supposed to be a presentation this week in the US on the tax plan.
There's a speech.
Tell us about that.
There's a speech in Indianapolis this week. I think Paul Ryan, the Speaker of the House, who's a tax expert for Trump, they're going to be speaking, and apparently they're going to be outlining what this tax reform package will mean. So that will excite the market when they start seeing some details. Yeah,
excellent. So commodities. Yesterday we were basically into a bear market
for iron ore.
For iron ore. Prices have come off. Do we think we've hit a bottom there? And what are the sort of the key drivers that are affecting the commodity prices at the moment? China being one, of course.
You've got to remember that iron ore has really spiked this year. It was really low.
It's run hard.
Yeah, it's run hard up, and it has come back 20%. But if you look at it over the year, it's up. Could be up 20% over the year. So,
and the earnings season showed that with the results of all the miners.
Yeah, exactly. And I interviewed Michael Knox from Morgans in Brisbane, and Michael is a commodities expert. That's part of his beat.
He thinks he is.
Well, I think he's regarded even.
He's very good.
Yeah, he is. He's an econometrician as well, so he's an economist who actually can understand numbers. But his modelling of iron ore and oil prices have been very good, particularly on my show. And he says we've basically hit the level where it's more likely to go sideways. The $67, $63, that kind of band is good, and it's good for miner share prices. We'd like it to be higher, but the fact that they've come from low levels to where they got really high, the 67 is 65, not a bad price.
And the miners all taken a lot of cost out over the last couple of years too, so they're pretty lean.
Exactly right. And there was a fantastic story in the AFR last weekend about the next boom around infrastructure. And that's right around the world, Marty. And when you do infrastructure, you always demand iron, steel, for the roads, for the bridges, for the buildings. So I think we're going to be fairly well placed over the next few years.
So the banks, they've been monopolising the headlines. They got some good PR this week in terms of taking away fees on ATM withdrawals from
foreign banks,
from competitor ATMs. Not really going to have much of an impact ultimately on the bank's bottom line.
500 million across the banks. There's a lot of 100
million each or something, which is like thousandth of a percent.
It's a mere bagatelle. And also, let's face it, the banks will sneakily impose fees on those sort of customers who aren't price sensitive. And a lot of successful businesses, even though they prefer lower fees, they're so busy growing their businesses, they're not watching about the small creeping up of their bank fees, which might go from $1,000 to $1,100, 10% increase, but they often don't see that.
Yeah, and a lot of people are using digital technology now anyway to pay for things, smartphones and a lot more plastic, cashless
There's
society.
savings for the banks.
So on the more important question though, do you think the bad news is out of the way for the banks? They're still targeting them around executive remuneration. There's a whole lot of headwinds that they're facing.
I think the worst stuff is the other way, Marty. And
so are they a buy?
Look, I just think if you weren't holding banks at all, I think they are, because even Goldman Sachs downgraded the CBA this week, but they downgraded from a level in the 80s down to 77. Now the CBA is still 75, and my argument is if the economists who are bullish on the Aussie economy are right, believe in this big infrastructure boom, and that article, by the way, Craig James said, he reckons that the infrastructure boom could be 1.5 times bigger than the mining boom. If that's the case, the Aussie economy grows really strongly next year, and who are the greatest beneficiaries when the Aussie economy grows really strongly? The banks. And when interest rates go up, who are the beneficiaries? The banks. So from that point of view, if you want to take a punt on good companies anyway, even if you're wrong, you're stuck with good companies that pay dividends, they're probably not a bad play.
That's why we started the Switzer Dividend Growth Fund.
Exactly right.
I'm Peter Switzer.
I'm Peter Switzer, and we're mad about money.